Scott Bessent just admitted something most Treasury secretaries never say out loud. He said there is nothing magic about the number $40 trillion. But Wall Street disagrees. Because this week, America's national debt officially crossed $40 trillion. Not projected to cross it, not approaching it, crossed it. The Treasury Department confirmed it in a routine daily report, almost like it was announcing the weather. 40 trillion, 05 billion to be exact, more than double what it was less than a decade ago. Think about the pace for a second, because the pace is the real story here. It took the United States over 200 years, from its founding all the way to 1982, to hit its first $1 trillion in debt. It took about 26 more years to reach 10 trillion in 2008. It took roughly 14 more years to reach 30 trillion back in 2022. And now, just a handful of years later, we've already blown past 40 trillion. The math isn't just growing. The rate at which it grows is growing. Break it down to a human scale and it gets even more uncomfortable. Divide $40 trillion across every person in the country, and you're looking at roughly $120,000 of federal debt per citizen. Divide it by household instead, and the number climbs well past $250,000 per household. Every single one of us is, in a sense, a co-signer on a loan we never agreed to, that keeps getting bigger every single day, whether we're paying attention or not. The Congressional Budget Office has projected that federal debt will keep climbing for the next decade, with no reversal in sight under current law. And while the nation has long carried a significant amount of debt, several very specific trends have alarmed budget experts more than usual this time. The tab is growing faster than it used to. Interest payments are ballooning because both the rates and the raw amount borrowed have both risen at the same time. And all of this is happening during relatively good economic times, not during a war or a recession, which is exactly when a government is supposed to be paying debt down, not piling more on. That last point is the one economists keep repeating, almost like a warning label. Normally, deficits shrink when the economy is strong because tax revenue rises and spending on things like unemployment benefits falls. This time, the deficit stayed enormous anyway. And while that number is enormous, the number that should actually worry you is smaller. It's 5.33. That's the yield on the 30-year Treasury bond. The highest it has been since June of 2007, before the iPhone had even been on shelves a year, before the word subprime became something every American understood. Back then, that yield level was a warning sign for what came next. The 2008 financial crisis, now the same number is flashing again, and the 10-year Treasury yield, the one tied to your mortgage, your auto loan, your credit card rate, just touched 4.75, its highest level since January of 2025. Let that sink in for a second. The government's debt is at a record high, and the cost of that debt is at a 19-year high. At the exact same time, that combination is not supposed to happen quietly, and it isn't. Treasury Secretary Scott Bessent has been scrambling. On a Wednesday in the middle of August, his department made a surprise announcement. It would at least double the size of its buyback operations for long-dated government bonds, from $2 billion per operation to at least $4 billion. The plan runs from September 9th through November 4th, conveniently right through the final stretch of the midterm campaign season. For a moment, it worked. Yields dropped. The 30-year bond fell about 10 basis points after touching its highest level in almost 2 decades. Stock futures jumped. It looked like Bessent had bought the market some breathing room. Then the next day came, and Bessent went on CNBC and said something that should have calmed markets but didn't. He said the buyback could end up being even bigger than $4 billion per operation. He wouldn't give a number. He said it depends on conditions. He said the goal was to get investors to focus on the fundamentals and stop reacting to headlines in what he called a thin summer market. He also admitted something telling. He said liquidity in the 30-year bond specifically was, in his words, very poor. That is not something a Treasury Secretary says when things are fine. He also brought up something unrelated on the surface, but connected underneath. He mentioned the ceasefire tension involving Iran as one of the temporary factors distorting bond pricing right now. Oil prices spiked as that conflict flared, and higher oil prices feed directly into inflation expectations, which feed directly into how much yield investors demand to hold long-term debt. So it's not just deficits and debt levels driving this move. It's deficits, debt levels, geopolitics, and inflation, all hitting the bond market from different directions at nearly the same time. That kind of pileup rarely happens by coincidence. And the market's response told the real story. Within hours, yields were rising again. The 30-year climbed back above 5.2%. The 10-year pushed back toward 4.7%. All of the improvement from the buyback announcement evaporated. One JP Morgan analyst put it bluntly in a note to clients. She said these interventions belie the underlying structural challenges and do nothing to address them. In plain English, Bessent can rearrange furniture. He cannot fix the foundation. So what exactly is the foundation problem? It comes down to arithmetic that has been building for years and is now impossible to ignore. The federal government is running a deficit of somewhere between $1.9 and $2 trillion this year alone. That is the gap between what Washington spends and what it collects in taxes. To cover that gap, the Treasury has to borrow. It does that by selling bills, notes, and bonds at regularly scheduled auctions. Investors buy that debt. The government promises to pay them back, plus interest. For most of modern history, that system worked smoothly because Treasury bonds were considered the safest asset on planet Earth. But now investors are asking for more in return for holding that debt. And the reasons are stacking up. Reason 1, inflation is still running above the Federal Reserve's 2% target, thanks in part to a spike in oil prices tied to conflict in the Middle East. Reason 2, the sheer size of government borrowing keeps growing, with no real plan to slow it down. Reason 3, there's a new complication nobody was talking about 2 years ago: artificial intelligence. Companies like Amazon, Alphabet, Meta, and Oracle have been issuing bonds at a pace nobody has ever seen to fund a data center build-out that could eventually top $3 trillion. Through the first week of July alone, those 4 companies issued about $194 billion in bonds. That's 79% more than they issued in the entirety of last year. Analysts expect AI-related debt issuance globally to hit $570 billion by the end of this year. Every one of those corporate bonds is competing directly with the U.S. government for the exact same pool of investor capital. When investors have to choose between a government bond and a corporate bond, and both are offering higher and higher yields, Washington doesn't automatically win. It has to compete, and competing costs money. That brings us to the number that should scare you more than $40 trillion. Interest. The federal government now spends more than $1 trillion a year just paying interest on the debt it already owes. That is more than the United States spends on national defense. Let that sit for a second. The single largest line item creeping toward the top of the federal budget isn't the military. It isn't Social Security. It's the interest payment on money already borrowed. And here's the part that makes this dangerous instead of just uncomfortable. It's a loop. The government runs a large deficit, so it borrows more money. More borrowing means more bonds hit the market. More bonds on the market means investors demand higher yields to absorb the extra supply. Higher yields mean higher interest costs on all that debt. Higher interest costs make the deficit even bigger, which means the government has to borrow even more, which pushes even more bonds into the market, which pushes yields even higher again. Around and around it goes. There's a historical echo here that bond traders keep bringing up, almost like a ghost story. The last time the 30-year yield sat at these exact levels was the summer of 2007. Back then, nobody outside of Wall Street had heard the word subprime yet. The financial system looked calm on the surface. Then it wasn't. Within about a year, yields on long-term bonds collapsed as the entire system seized up, and the Fed slashed interest rates aggressively just to keep the economy breathing. Now, to be fair, the parallels aren't perfect, and it's important not to overstate them. Banks are far better capitalized today than they were heading into that crisis. The pressure this time is coming primarily from government borrowing and inflation, not from a private sector credit bubble hiding inside mortgage-backed securities. But the psychological echo is exactly why every headline about the 30-year yield keeps mentioning 2007. It's the last time the market sent a warning this loud, this consistently, over this many months in a row. Economists have a name for this. They call it a debt spiral when it gets bad enough. We are not there yet. But we are circling closer to it than at almost any point since the 2008 crisis. And there's a specific warning buried inside a document most Americans have never heard of. It's called the Treasury Borrowing Advisory Committee, TBAC for short. It's a panel of senior bond dealers and investors that quietly advises the Treasury on how much debt it can realistically sell. In minutes released in early August, TBAC delivered a warning that should have been front-page news everywhere. At current auction sizes, the government faces a $1.45 trillion funding shortfall in fiscal years 2027 and 2028. That number has been climbing every time this committee meets. Back in February, the shortfall estimate was $1.1 trillion. By May, it had grown to $1.3 trillion. By August, $1.45 trillion. The gap is widening every few months, not shrinking. JP Morgan has gone even further, projecting a $3.7 trillion funding gap between 2027 and 2030 if nothing changes. So what does Bessent do with a warning like that? He's chosen a strategy that helps him today, but creates risk tomorrow. He's been leaning heavily on short-term Treasury bills instead of long-term bonds. Why? Because short-term bills currently carry lower yields than the long-dated stuff. At the time of this recording, a 3-month bill was yielding around 3.8%, while the 10-year sat near 4.6% and the 30-year sat above 5%. If you were the one borrowing money, you'd probably do the same thing. Borrow cheap now. Worry about tomorrow later. But there's a catch, and it's a serious one. Short-term debt has to be refinanced constantly. Every few months, that bill comes due, and the government has to roll it over into new debt. If interest rates are higher when that happens, Washington gets stuck refinancing enormous piles of debt at a worse rate than before. Bank of America projects that Treasury bills could make up nearly 25% of all outstanding government debt by fiscal year 2027. If Bessent doesn't change course, that's up from the typical range of 15 to 20%. Here's why that matters more than it sounds like it should. Treasury bills are the government's version of a variable rate credit card. Bonds are more like a fixed rate mortgage. Right now, Bessent is loading up on the credit card version because the rate looks better today. But a credit card's rate can change every time it's renewed. A 30-year bond locks in a rate for 3 decades, for better or worse. By leaning so heavily into bills, the Treasury is making a bet that short-term borrowing costs will stay low or fall over the next few years. If that bet is wrong and rates stay elevated or climb further, the refinancing bill comes due much faster than it would have with long-term debt, and it comes due again and again every few months, compounding the exposure each time. In other words, the government may be trading a small win today for a much bigger headache down the road. One investment officer described the buyback strategy this way. He said, quote, "This is not a debt paydown, it is just a rearrangement of the maturity schedule, meaning the total amount owed doesn't shrink. It just gets repackaged into shorter, more frequently renewed pieces." Now here's where it gets even more complicated. There's a new player at the Federal Reserve, and his name matters more than most people realize. Kevin Warsh was sworn in as Fed chair earlier this year, replacing Jerome Powell. President Trump wanted someone who would cut interest rates aggressively. He said publicly that he wanted Warsh to be totally independent, but also said at a rally that rates would come down very quickly. Those two statements don't exactly line up. And so far, Warsh has surprised a lot of people. Speaking at a central bank conference in Europe, he made it clear the Fed would stay focused on fighting inflation, even if that meant disappointing the White House. He said if anyone expected the Fed to tolerate inflation above 2%, quote, "I guess they'd be disappointed. That is not the language of a Fed chair who's about to slash rates on command," which puts Warsh in an incredibly difficult position. If the Fed cuts rates to ease pressure on the economy and on the government's borrowing costs, it risks signaling that it's willing to tolerate more inflation. And bond investors hate that signal. They respond by demanding even higher long-term yields, which defeats the entire purpose of the rate cut in the first place. If the Fed holds rates steady or raises them to fight inflation, short-term borrowing costs stay elevated, and the government's bill-heavy strategy becomes more expensive too. There is no clean way out of that box. There's also a structural issue sitting quietly underneath all of this, separate from interest rate decisions entirely: the Fed's own balance sheet. After years of buying bonds to stabilize markets during past crises, and then slowly trying to shrink that balance sheet afterward, it still sits well above where it stood before the 2008 crisis, even after a long stretch of what's called quantitative tightening. A bloated Fed balance sheet complicates how much room the central bank has to step in and support Treasury markets directly if things get genuinely disorderly, since it's already sitting on a massive pile of assets from the last time it did exactly that. Warsh has said reducing that balance sheet further is one of his priorities. But doing that while also managing inflation, managing political pressure, and managing a nervous bond market all at the same time is an extraordinarily difficult balancing act for anyone, let alone someone in his first year on the job. Meanwhile, foreign investors are watching all of this closely, and their behavior is shifting. Japan remains the largest foreign holder of U.S. Treasury debt, with more than $1 trillion in holdings. China has been steadily reducing its position for years, from a peak north of $1.3 trillion down to somewhere around $700 billion. In one recent month alone, Japan and China combined sold roughly $90 million worth of treasuries in a matter of weeks, according to Treasury data trackers. To be fair, this isn't a mass exodus. Total foreign holdings of U.S. debt actually hit a record above $9 trillion earlier this year, so foreign money hasn't abandoned America. But the composition is shifting, the appetite is more selective, and the days of blind, unlimited demand for U.S. debt appear to be over. One analyst summed up the psychology well. When a country's deficit is wide, and its trade relationships feel unpredictable, and its political institutions seem less stable than they used to, investors quietly demand a bigger premium to hold that country's bonds. That premium doesn't show up as a headline. It shows up as a slightly higher yield at every single auction. Multiply that by trillions of dollars in debt, and slightly higher yields become hundreds of billions of dollars in extra interest expense over time. It isn't only sovereign buyers pulling back a little either. A newer category of buyer has quietly become one of the largest holders of short-term U.S. government debt. Stablecoin issuers. Companies behind major dollar-pegged cryptocurrencies have been parking enormous reserves in treasury bills to back the coins they issue, with one issuer alone reporting more than $100 billion in treasury bill holdings. That's a genuinely new source of demand that didn't exist in any meaningful way a decade ago. It's propping up part of the bill market, even as some traditional foreign buyers get more selective. Whether that's a stable long-term source of demand or a newer, less tested one, is something even seasoned bond strategists are still debating. Now let's talk about what this actually means for you, because Wall Street jargon doesn't pay your bills, but these numbers eventually do. Mortgage rates typically track the 10-year Treasury yield, plus roughly 1.5 to 2 percentage points. With the 10-year sitting near 4.75%, mortgage rates have been climbing back towards 7%. That directly impacts how much house you can afford and how much your monthly payment ends up being if you're buying or refinancing right now. Auto loans track a similar pattern. Credit card rates too. Corporate borrowing costs rise as well, which can slow hiring, slow expansion, and slow wage growth across the broader economy. For the housing market specifically, the impact is especially direct. With mortgage rates drifting back towards 7%, home buyers lose purchasing power fast. A buyer who qualified for a certain home price at a 5.5% rate a couple of years ago may only qualify for a noticeably smaller loan at today's rate on the exact same income. That's already showing up in slower home sales in a lot of markets, and in sellers having to adjust price expectations that were set during the lower rate years. It's also part of why so many homeowners who locked in ultra-low rates years ago are choosing to stay put rather than sell, which keeps inventory tight and keeps the whole housing market feeling stuck. Higher borrowing costs quietly touch almost every corner of the economy that people actually live inside, long before it ever shows up as a headline about bond yields. Even the stock market feels it. Rising yields make future company earnings less valuable in today's dollars, especially for growth-heavy sectors like technology. The S&P 500 has already had multiple rough sessions this year directly tied to yield spikes, with chip stocks leading the declines each time. There's also a global piece to this puzzle that most coverage skips over entirely. The United States is not the only country facing this kind of pressure right now. Japan's 10-year government bond yield recently hit its highest level in 3 decades. Germany's 30-year bond yield climbed to levels not seen since 2011. British government bond yields have been rising too. This is a synchronized move across almost every major developed economy at once, which tells you something important. Investors everywhere are repricing what they're willing to accept for holding long-term government debt, no matter whose flag is on it. That actually makes the U.S. situation both a little better and a little worse at the same time. Better because it means America isn't uniquely mismanaged compared to its peers. Worse because it means there's less of a safe alternative for global investors to run toward if they get nervous, since practically everyone's long-term bonds are getting more expensive to hold at once. So this isn't an abstract Washington problem. It touches your mortgage, your car payment, your 401ks, and your job market, whether you follow bond markets or not. Now, is this the end of the world? No. And it's important to say that clearly because fear sells clicks, but it doesn't help you make good decisions. There is currently no evidence of a Treasury buyer's strike. Investors are still showing up to auctions. Foreign holdings of U.S. debt are still near record highs in dollar terms. The dollar has not lost its reserve currency status. Nobody serious is predicting an outright U.S. default. Bessent himself insists the country will simply grow its way out of the debt, pointing to a possible peak in this year's deficit, driven partly by one-time factors like court-ordered tariff refunds that won't repeat next year. He's also floated a new fiscal consolidation plan, working alongside Budget Director Russ Vought, aimed at cutting waste, fraud, and unnecessary state grant funding, potentially saving several $100 billion. Those are real efforts. They might genuinely help at the margins. Bessent has also pointed to renewed tariff revenue as part of the solution, arguing that new duties, implemented under different legal authority after the Supreme Court struck down the prior round, should bring in comparable revenue going forward without the one-time refund drag that inflated this year's deficit. He's argued that letting companies immediately expense new factory investments will cost the government some near-term revenue, but grow the overall tax base over time, which he says more than pays for itself eventually. Whether that math works out the way he's describing is genuinely disputed among economists, and won't be provable for a few more budget cycles at least. But here's the uncomfortable truth underneath all of it. None of these measures, not the buybacks, not the bill-heavy strategy, not a modest spending cleanup, actually eliminates the structural gap between what Washington spends and what it collects. That requires something much harder. A real political decision about taxes, about entitlement spending, about the size and shape of government itself. And that is the one thing neither party in Washington has been willing to seriously tackle in years. Because cutting spending is unpopular, raising taxes is unpopular, and running deficits until now has felt consequence-free. The bond market is quietly ending that illusion. Not with a dramatic crash, not with a single headline-grabbing collapse, but with a slow, steady repricing that shows up in your mortgage rate, in your car payment, in the return on your retirement account, and in the government's own budget math. here's the mental model that actually matters, more than any single number in this video. You do not need investors to stop lending to America for this to become a real problem. You only need them to demand more to keep doing it. That's it. That's the entire crisis in one sentence. Not abandonment, just a rising price for trust. And every basis point of that rising price compounds across $40 trillion of debt, year after year, auction after auction. The Peterson Foundation estimates that if nothing changes, the national debt could reach $50 trillion within about 6 years. 6 years from 20 trillion to 40 trillion. Then, potentially, 6 more years to reach 50. The pace itself is accelerating, not slowing down. One budget watchdog leader put it in a way that stuck with a lot of people who heard it. He said the country has been running deficits for roughly 26 straight years, largely ignoring the structural problems baked into the budget. And like any debt problem, the longer it gets ignored, the worse it becomes. That's not a partisan talking point. It's just arithmetic, repeated by people who've been watching this build for decades. So where does this actually go from here? Watch 3 things over the next several months, because they will tell you more than any political speech will. First, watch whether the TBAC shortfall estimate keeps growing at the next quarterly meeting, or whether it finally stabilizes. Second, watch whether Bessent's promised fiscal consolidation plan produces real, scored budget savings, or turns out to be more messaging than substance. Third, watch what Kevin Warsh's Fed actually does at its next meetings, because the tension between political pressure for rate cuts and the Fed's inflation mandate is going to define bond market behavior for the rest of this year. None of these 3 things will produce a single dramatic headline that says, crisis averted or crisis begins. Instead, they'll show up gradually in auction results, in yield curves, in mortgage rate tables, and the fine print of Treasury press releases that most people scroll right past. That's exactly why so few people saw this coming, and exactly why understanding it now puts you ahead of almost everyone around you. It's also worth remembering that this isn't the first time in American history that debt fears have dominated headlines, only for the country to muddle through without a collapse. Warnings about unsustainable debt have circulated for decades, through the $1 trillion milestone in the 80s, the $10 trillion milestone during the financial crisis, and the $30 trillion milestone just a few years ago. Each time, the system bent without fully breaking. That history is exactly why some analysts argue this current wave of concern is overblown, just another chapter in a long-running story that always seems to find a way to keep going. But there's a difference between it hasn't broken yet and it can't break. Every additional $1 trillion, every additional basis point of yield adds another link to a chain that eventually has a breaking point, even if nobody can say exactly where that point sits in advance. Because the biggest financial stories rarely announce themselves with a bang. They build quietly in places like Treasury auction results and advisory committee minutes, until one day the number is simply too big to ignore. $40 trillion was that number this week. It probably won't be the last one. The question now isn't whether America can keep borrowing money. It clearly can, and investors are clearly still willing to lend it. The real question is what interest rate Washington will have to pay to keep doing it, and how much of your future paycheck, your future mortgage, and your future tax bill gets consumed servicing debt that's already been spent. Because that bill doesn't disappear, it just moves down the road, gathering interest as it goes. And right now, more people are starting to ask how much further down that road America can actually go, before the math finally forces a decision nobody in Washington wants to make.